The purpose of this presentation is to help you better understand the new world of factor-based investing and provide you with some tools to help explain the benefits. We're going to begin with establishing the criteria for determining which exhibits in the factor zoo we want to consider for investments. To be considered, a factor must provide incremental explanatory power to portfolio returns, have delivered a premium return, and should also meet all of these criteria that you see. It must be persistent, meaning it holds across long periods of time and different economic regimes. It should be pervasive, meaning it holds across country, regions, sectors, and even asset classes. It should be robust to avoid problems of data mining, meaning it has to hold for various definitions if it's possible. For example, there's a value premium, whether we measure it by price to book, earnings, cash flow, sales, dividends, EBITDA, enterprise value, doesn't matter. There's a robust value premium. It should also be investable, meaning it has to hold up after considering all costs, not just trading costs. And it has to have an intuitive, risk-based or behavioral-based explanation for the premium, providing you the rationale for believing that it should continue to exist. Now, the factors that meet these criteria, we think, are market beta, size, value, momentum, profitability, and its kissing cousin quality, carry, and term. For those of you not familiar with the quality factor, quality stocks have these characteristics. They have low earnings volatility, they have high margins, that's profitability, and why quality and profitability are highly correlated, related. They have high asset turnover, that meaning they use their capital efficiently. They have low financial leverage, little debt. They have low operating leverage. They're not like an airline. And they have low specific stock risk or low idiosyncratic risk. Now, with these factors, we have a new way to think about diversification. Rather than viewing a portfolio as a collection of asset classes, we can view it as a collection of diversifying factors. Now, support for such factor-based investing strategies is provided by Antti Ilmanen and Jared Kaiser in their 2012 paper, "The Death of Diversification Has Been Greatly Exaggerated." The paper, which won the Journal of Portfolio Management's award for the best paper of the year, made the case that factor diversification has been more effective at reducing portfolio volatility and market directionality than asset class diversification. And this presentation is about how to use the knowledge about factors to build more diversified, more efficient portfolios. Now, before we dive into this brave new world of factor-based investing, it's important to review a basic fact that factors are long-short portfolios. For example, beta is the return of stocks minus the return on one-month bills, and here we specifically mean market beta. Size is the return of small minus the return of large stocks, and value is the return of value stocks minus the return of growth stocks. And in the definition, it's always the average annual returns we're talking about. Now, since beta is the measure of the risk of a portfolio relative to the risk of the stock market, a total stock market fund has, by definition, an exposure to beta of 1. However, while a total stock market fund has a 10% allocation to small stocks, it has no exposure at all to the size factor. Now, this seeming contradiction confuses many investors. The reason for the confusion is that while the small stocks in a total market fund provide positive exposure to the size factor, the large stocks in the total market fund provide an exactly offsetting amount of negative exposure. That puts the net exposure to the size factor at 0. Similarly, while roughly 30% of the holdings of a total market fund are value stocks, providing positive exposure to the value factor, the growth stocks in a total market fund provide an exactly offsetting amount of negative exposure, resulting in a net exposure to the value factor of 0. Thus, a total market portfolio has the following factor exposures: market beta 1, size 0, value 0. Similarly, a total market portfolio that has 0 exposure to other factors such as momentum, profitability, and quality. Thus, it's not diversified across factors that determine the variation of returns between portfolios. In order to diversify a portfolio across the size and value factors, you must tilt, is the word commonly used. You have to tilt the portfolio so that it owns more than the market share of small and value stocks. Now, since these 3 factors have provided premiums, gaining exposure to these factors provides you and investors with 2 asset allocation options. The first option, and the conventional way, I might say, to use exposures to these factors, is to increase the expected return of the portfolio. And since the factors have very low correlation to each other, as you'll see, the diversification benefit of tilted portfolios has historically produced higher Sharpe ratios, earning higher returns while experiencing similar volatility. This table provides the annual correlation of returns of the 6 equity factors to each other for the period from 64 through 2016, and it's U.S. data here. With the sole exception of the high correlation between the related profitability and quality factors, and you saw why profitability is part of quality, so that should be expected. The other correlations are low to negative. And you'll note in particular, I've highlighted in red the negative correlation of momentum to market beta, size, and value, showing diversification benefit of adding exposure to the momentum factor to a portfolio that has exposure to these other factors. And as I mentioned, there's a second way to use tilting. Instead of focusing on increasing expected returns while holding risk about the same, you can focus on reducing risk while holding expected returns about the same. That's accomplished by lowering your exposure to market beta at the same time you're increasing your exposure to the other factors. You need less exposure to beta to achieve the same expected returns because the equities you do hold have a higher expected return than does the market portfolio. The result is that your portfolio has now become more diversified in terms of its exposure to factors. Your exposure to market beta went down, while your exposure to the other equity factors went up. In addition, because you're now holding more safe bonds, your exposure to term risk went up, further diversifying your portfolio. And because stocks are so much more volatile than bonds, a typical 60-40 portfolio has much more than 60% of the risk concentrated in the stock allocation or market beta. This is a point that is lost on most investors. Let's see why this is the case. As you can see, a typical 60-40 portfolio, one that invests in a total market fund, has about 80% of its risk in the single factor of market beta. And that's because, as the numbers show here, a 60% equity portfolio, typical equity broadly diversified portfolio, has a volatility of about 20. So if we think about it in risk points, we end up with 60 times 20 or 1,200 risk points. The bond exposure, we have 40%, a high-quality 5-year intermediate bond portfolio has a volatility of about 5, that's 200 risk points. Add them together, we're at 14, and we have 86% of the risk. Now, if you have a shorter-term bond portfolio, then you'd have even less risk allocated to bonds, maybe 90% or more of your risk would be in the equity portion. Of course, if it was a longer-term bond portfolio, the numbers would be a bit less. Now, by tilting the portfolio to the other equity factors that have provided premiums and lowering the exposure to beta, you're able to reduce the concentration of risk in beta while increasing it to the other factors, including the term factor. That will create more of what can be referred to as a risk parity portfolio, a portfolio which has more equal weightings to each factor, as the following example is going to demonstrate this point. So we're going to consider two portfolios. The start date is April 93 because that's the start date of DFA's small value fund. And we're going to go through December 2016. Our portfolio A is a market-like portfolio using Vanguard's U.S. market fund for the equities and 40% in an intermediate treasury fund. And you can see those returns and the volatility as well as the loadings on the factors. The numbers inside of the parens you see are the loadings of the fund on that factor. So obviously a market fund like Vanguard's total market fund is going to have a beta of 1. We multiply it by 60% to get the loading on market beta, and so we end up with 0.6. And the other exposures show you that. The term premium intermediate fund has a loading of about 0.4, times that by 40%, so we load 0.17 on the term factor. Portfolio B, because small value stocks have a higher expected return, we don't need to hold as much equity. Here we're looking at a 40% equity allocation that allows us to hold 60% in Vanguard's intermediate term treasury. You can see we had similar returns, but portfolio B produced a much more efficient result, higher returns with less volatility. And the reason this happened is this low correlation of the factors, and we have more of an equal weighting. The loading on beta of the DFA small value fund was a little above 1, as you might expect. Small value stocks are a bit more risky, higher volatility, so the market beta is likely to be above 1. Multiply that, same thing for the other factors, and we even up the term loading because we're able to hold 60% there, and you can see a more equal weighting. And through the use of long-short portfolios, such as AQR's multi-style premium fund, even more of a risk parity portfolio can be constructed. And you can see the benefits of diversifying across factors in the following table.